it's now 2026. If you haven't started investing already, it's now the time. As they always say, the best time to start investing was yesterday, and the second best time is today. So if I had to start over today in 2026, this is exactly how I would do it. And we're going to be focusing on four aspects specifically. We will answer four questions, which are: why do we invest? What do we buy? Where do we put it? And more especially for people that are forward looking, is how do we spend it? Because it's not all about just, kind of compounding and increasing our wealth, but it's also thinking ahead of time to how do we best spend it when the time finally comes. So if you're interested in this, then keep on watching. So let's start from the why do we invest? Investing is the single biggest source of wealth creation for the average investor and for the average person. Of course, yes, creating a business and owning something that has the potential to then be sold, for example, like exited, is a huge wealth creator potentially if it goes well, but that's a big if. And not everyone is made for entrepreneurship. Not everyone will be successful in entrepreneurship. Not everyone wants to be an entrepreneur. I think entrepreneurship has been idolized and romanticized as well, and so it's important to realize that, again, whilst yes, it's probably the fastest potential wealth accelerator and creator that we have access to, stock investing and market investing is the most accessible and most autopilot-y way to create wealth for the average investor. And the thing that people forget is that you need to have a long-term horizon to really start seeing the value and the magic of the stock market and of compounding really doing its thing. So if I were to start investing today from scratch with nothing in my bank account, I would prioritize one, first of all, understanding what my chosen percentage of income that I want to allocate to stocks is. Ideally, this would fall between 25-30%, right? The higher the better, of course, but ideally you want to be spending at least 25 to 30% of your net income into long-term investing for your wealth creation, for your future. And I would be doing so through as diversified an exchange traded fund or an index fund as possible. So that would be VWRL, for example. That's the FTSE All World index. Or if you're based in the US, that could be SWDA. That's the S&P 500 one. VUAG, so VUAG is the same for Vanguard. Basically, you get the gist. As broad of an ETF as you possibly can, and set it and forget it. I would pick a brokerage with as low commissions as possible. Ideally, there's so many now that offer literally zero commissions, zero trading fees. So there's no excuse to not pick one that has zero commissions. So I would pick that. I would automate investing from my bank account to the brokerage every first or second of the month, and I would pick one ETF to keep things as simple as possible and just invest every single month with no fail. And something that can give even the most skeptical investor some solace and some conviction is that yes, the market has been quite volatile and can be quite volatile, as we all know, as I will have seen, and as we will definitely continue seeing. However, there is, while in the next 24 hours, if you take a 24-hour timeline in terms of investing. So if you say, okay, I'm going to invest some money now and I want to take it away from the market, out of the market in 24 hours, there is a 52% chance that you will see an increase in your money. If we extrapolate an even longer timeline and we increase it to, let's say, 20 years, there is near 100% certainty that your money will grow. So this is incredible, right? And again, it's something that we can all get access to. And I cannot emphasize enough how even 25-50 pounds a month, if you start now, are going to make such a big difference over a long-term period. Now, what do we buy? In 2026, the temptation to try and pick the next bubble, try and navigate the next wave of technology, of the next Nvidia, the next whatever else, is very high. And it seems like, especially if you navigate certain corners of the internet, everyone has the next stock pick, the next thing to bet on. This is a pointless exercise. I cannot emphasize this enough. You may get lucky, you may find something that does well, but not even the very well paid hedge fund managers, portfolio managers at these huge institutions manage to consistently outperform the market. The only investors, or like the most famous investors that manage to sometimes beat the market, are ultra billionaires like Warren Buffett and Charlie Munger, etc. And these guys have been in the game for many 60, 70 years, and even they recommend that for the average investor, for vast majority of people, the best investment is as a diversified an index fund or an exchange traded fund as possible. And nowadays, that means I gave a few tickers. I'm going to include below a few tickers. Again, this is not financial advice. This is my opinion. And, coming from someone that has been invested in the market for a decade and has read probably 30, 40 books on the topic. So it's my advice. Well, it's not my advice. This is my opinion, something that I'm personally doing myself as well. I'm going to include my portfolio. If that is interesting, I can do a rundown of my own portfolio. But at the moment, I've actually chosen to reduce and simplify my own portfolio massively. I used to have 12, 13 different ETFs just a few months ago. And then I read The Simple Path to Wealth by J.L. Collins, which is a classic in the personal finance world. I hadn't read it, and it's something that really made me reconsider why I was going through all these hoops in trying to, diversify my portfolio based on, these like varied ETFs, when more often than not, the best strategy for long-term investing is to hold, again, S&P 500 or an all-world ETF, so something that literally encompasses all geographies, all sectors, all industries, and just set it and forget it. And yeah, so this is now the strategy that I'm doing myself. I have a little bit of diversification in the sense of I've added a few, like a 5% of my portfolio in emerging markets, 5% on, I want to say S&P 500 specifically, just to over-index a little bit more on the US, and that's about it. So literally 3 ETFs, and I'm calling it a day. So simplifying, automating. And the thing is, the market, these indexes, the beauty of them is that they're self-cleaning, meaning that companies that don't perform well anymore are not going to be included in those indexes automatically anymore. So you're not going to be invested in those companies anymore. And they are already going to be over skewed on whatever geography or industry is outperforming, because again, it's going to take the most market cap. And so they're going to rise up and make up the majority of your portfolio anyways. So there is no reason for you to try and over engineer your portfolio unless you want to have fun with it, and unless you understand that it's something that is, to play some bets, and you allocate a very, very small percentage of your income and your portfolio to those individual picks. Other than that, just stick to wide and diversified ETFs. To talk about the where I would be investing if I started now, most countries, most developed countries, have some sort of tax advantaged accounts, and it's extremely important that you take note of these, understand what these are, and make the most of these accounts. There is literally no reason why you wouldn't be making the most of these tax wrappers that protects your money from being taxed. Now, these are normally post-tax monies that go into these accounts, so you have already been taxed on the money that you put in those accounts. So what is tax-free is any gains that are happening in this wrapper, and so in the moment that you go to withdraw that money is going to be tax-free, which is amazing. So in the UK specifically, this is what your ISA, your individual savings accounts are. Name is a little bit misleading because it says individual savings accounts, but in reality there's different types of ISAs, and I've made different videos on these. But for these purposes, for our intents and purposes, if I were to start investing now in 2026, I would be using a stocks ISA, stocks and shares ISA. And yeah, so this gives me all the tax advantages of any type of ISA. And the alternative would be to then also make the most of my workplace pension or any other type of pension if I'm a self-employed, or if I also want to make even more tax advantage contributions. I would use, again, workplace pension. Definitely make sure to match up to the employer's match. This is literally free money. It's like 100% return on your money that you put in. So definitely make sure to contribute up to the employer match. In my company, that's 4%, for example. So I have a 4% contribution. But you may also want to choose a SIP, so an individual, a personal pension. And the pros of a SIP is that if the ISA is post tax monies, the SIP and the workplace pension are pre tax money. So, depending on which taxation bracket you're on, you may want to prioritize taking pre tax money and putting that away, or post tax money and like having the freedom to withdraw it at any point. Now, the drawback of a SIP or any type of pension is that you can't access that money. You have to lock it away until you are 57 as of now. Well, 55 as of now this day, but in 2027 it's going to go up to 57. So it's a choice, right? You have to play around, and for some people that want to retire earlier than that time, then it's important to have some other sort of money that you have away, because again, you're going to need some to live off some investments. So you will want to balance between the ISA and the SIP slash workplace pension. But the name of the game is making the most of these tax advantage accounts, and please study up what your equivalent is in your country. I know in the US there's the Roth IRA, 401ks, and things like these. So study up, and I'm sure that most developed countries have some sort of equivalent for these tax advantage accounts. And now the how. So how you're going to spend this money in the future. And again, if I were doing and starting now in 2026, thinking about how I'm going to be able to spend this money once I get to my retirement age, or a time where I don't want to be working full time anymore, there is the rule, which people familiar with FIRE, so financial independence, will have heard of, the 4% rule. So what that means is that if you withdraw 4% of money from your investments and are able to live off of that 4% annually, then this is when you have your financial freedom, and you have a near certainty of that money lasting forever, basically. So for the remaining of your portfolio to be able to, through compounding and through being in the stock market, to be able to replenish itself without you having to contribute actively to the pot of money, and without it ever running out. I think there's like a 96% chance of it happening and basically never running out. Of course, for those people that think, well, but there's still a 4% chance that that money might not suffice, I think I have two things to say, right? First thing is, especially depending on when you plan to retire, it's very unlikely that people will full on completely stop working at any point in time. So chances are you are still going to have some sort of income coming through, even once you're retired, let's say. But two, of course, one thing that you can do is, if you want to be more cautious, is stay below that 4%, right? So plan with a 3% uptake in mind as opposed to a 4%. And so what that means is that you're going to have to make your pot likely a bit bigger, right? If you're planning on living off of 3% of the returns. But for some people, that safety, that peace of mind of having basically a near certainty of that money being able to work and last forever is what they need. So to each their own. I think for me, if I were starting to invest now and planning for that FIRE, that financial independence, I would be counting on a 4%, because I think that, again, I would be thinking about retirement as like lying on a beach, never working again, never earning any type of money ever again. But to each their own, and I wanted to expose both types of thinking, so that each one of you guys can kind of like make their own judgments and understand what makes you feel better about your money. So to summarize, to put it all together, which is basically just summarizing the best advice or opinions and practices on personal finance, is, if I was starting in 2026, I would make sure that I spend less than I earn. This is the 101 of being able to have financial independence one day. I would avoid high interest debt like the plague, basically. And I would automate monthly investments into a global index fund, a global ETF with a low cost online brokerage account, and basically set it, forget it. And anytime I have spare money to invest, I would also make additional payments towards that, because every pound, every dollar, every euro that you put in the market now to work, it's making you one step closer to that financial independence and freedom, and location freedom and time freedom that we all desire at the end of the day, right? Because what is life for if not to spend it in a way that makes you happy, and you choose to spend it, and not having to perhaps work in a job that doesn't make you happy or content. So I hope you enjoyed this video. I hope you enjoyed this little recap of best practices of investing and the 4 pillars of thinking about your money. If you want that breakdown that I mentioned about my portfolio, what I'm invested in, which ETF specifically, which brokerage accounts I use, then let me know below, leave a comment. I'm planning on making those videos anyways, but if you're interested, then do let me know. I'm always here to hear. As always, if you want to speak one-on-one with me through a discovery call, free of charge, of course, then I'll leave the link to my Calendly below as well. Feel free to get in touch. You can write to me on LinkedIn as well. It's just my name on there as well, on the responsive. And other than that, I wish you all a fantastic 2026. I'll see you very soon. And in the meantime, take care. Bye bye.